All right, so we are going to start our new book. So, chapter one, in lesson one, using accounting principles and records. We have two objectives. You need to be able to explain the relationship between the accounting equation and accounting records. And then, learning objective two, you need to be able to explain the relationship between a subsidiary ledger and a controlling account. Now, some of this is going to be kind of review to start us off with. It says financial information for a business can be recorded, summarized, and reported in a variety of ways. If managers of individual departments want to use financial statements to assist in making decisions, information for each department must be recorded separately. So this is going to be new for us, having it in each department. All right, now this is nothing new. Our accounting equation, assets equal liabilities plus owner's equity. They're showing us that anything of value that's owned is called an asset. We know that. We also know that a liability is amount that's owed by a business. And then our owner's equity is financial rights to the asset of a business. So remember, if we're dealing with corporation, that's just called stockholders' equity instead of owner's equity. Accounting records show changes and the current account balance of each asset, liability, and owner's equity or stockholders' equity. Business papers from which information is obtained from a journal entry are called source documents. Again, that's something that we already know. The source document is the original business paper indicating that the transaction did occur and that the amounts recorded in the accounting records are accurate and true. Double entry accounting, the recording of debit and credit parts of a transactions. That's what we've been used to, or that's what we are used to doing. A journal is a form recording transactions in chronological order. We also use special journals used to record only one kind of transaction. And then we have our general journal that's used to record all business transactions if it doesn't fit into a special journal. Again, they're showing us our accounting equation, and now they're showing us our normal balance sides of those accounts. So we know that assets, debit on the left, credit on the right. We know then that our normal balance is on the left. It increases on the left, decreases on the right. Remember, normal balance is the same side that it increases on. This is just basic accounting stuff that we learned at the very beginning of accounting 1. Okay, so this should be all review. Liabilities, remember, on the right side of the accounting equation, so that means that they increase on the right side. Okay? Debit and credit sides never change. Debit is always on the left, credit is always on the right. It's just their normal balance, and their increase and decrease is going to change. Okay, we also have our owner's equity, so they've broken that up into, here we see our stockholders' equity, so a corporation. Debit and credit, left and right. Stockholders' equity is on the right side of the equation, so that means it increases on the right, decreases on the left. Normal balance is the same as the increase side, so the normal balance is on the credit side. Revenue makes our owner's equity increase, so that means that it's also going to be an increase on the right. Okay? Now, expenses is where it's going to change. Yes, when they talk about an expense and expenses on the right side of the equation, however, if you remember back to accounting 1, an expense decreases owner's equity. So since it decreases owner's equity, we're going to flip the increase and decrease side. So it's going to increase with a debit and decrease with a credit. Here they're just giving us a definition of an account, a record that summarizes all the transactions pertaining to a single item in the accounting equation is called an account. A ledger is our group of accounts. A ledger that contains all accounts needed to prepare financial statements is called our general ledger. Then we also have subsidiary ledgers. Those are the ledgers that summarize a single general ledger account. So that's when we're dealing with our accounts payable subsidiary ledger or accounts receivable subsidiary ledger. Those go with the controlling account. A controlling account is an account in a general ledger that summarizes all accounts in a subsidiary ledger. Here they're showing us then how we figure out our numbers, general and subsidiary ledger file maintenance. So our file maintenance is just the procedure for arranging accounts in a general ledger, assigning account numbers, and keeping records current. So remember, the first number is going to be the division. So is it an asset, a liability, owner's equity, revenue, expenses? Then we're going to go into the category that it falls within, and then the location within that category. All right, audit your understanding. Number 1, how is the accounting equation stated most commonly? This should be an easy question. Assets equal liabilities plus owner's equity. Number 2, what is the normal balance of an asset account and a revenue account? Remember, an asset is on the left side of the equation, so that means it increases on the left. That means that the normal balance side is the debit side. A revenue account is on the right side of the equation, so that means it increases on the right, and that means the normal credit or the balance side is on the credit side. And number 3, what are the 3 needs met by Wiley's account numbering system? This was that last slide. A, we're going to have a separate numeric listing is provided for each ledger division. Then B, a pre-designed arrangement of numbers is provided within each ledger division. And then C, account number digits are spaced to allow the addition of new accounts. All right, go ahead and go on to 1-1 work together.